Yeah, it's a big elephant. Yeah, big one. Whoa. Hello. No, still going, still going. So in this topic, we're going to look at some exclusions from gross income. You've learned about some different types of inclusions as well as the general rules of gross income. You're also going to learn now that there's different exclusions. So the idea here is once you go through the general definition of gross income, you focus on whether something is gross income. Then something that is gross income as defined by Congress is going to be specifically excluded. This is not the same thing as saying that something is not originally gross income. So what I'm saying is that your first question should be, is an item gross income? If the answer is yes, then you continue. If the answer is no, it's not gross income, it does not go on the tax return. If that item is gross income, then the next question, are there any specific exclusions that Congress allows? So these are items, these exclusions are items that under the general definition of gross income, the items that we've looked at already, what defines gross income, would normally be considered gross income. So for example, if you receive life insurance proceeds and you think about it through the three different elements of gross income, accession to wealth, does your net worth go up? Yes. You've got this amount of life insurance on someone's death, and now let's say you're the beneficiary, you receive, let's say, $1 million on your parents' death or your partner's, your wife or your spouse's death. Okay? You now have $1 million cash with no corresponding liabilities. Your net worth goes up. What about realization? Is there a realization event? Yes, severance has occurred. It's separate from the life insurance contract itself. And then finally, dominion control. Can you do whatever you want with $1 million? You bet. You've got gross income under the general rules. However, what you're going to see is that life insurance received as a result of someone's death is excluded from gross income of the beneficiary, a special rule laid out by Congress. We're going to talk about those special rules, as well as other exclusions. So again, the key here is understanding that in the previous topic, we defined gross income. If something was not gross income in that specific topic, it was not gross income. It will not go on the tax return. This topic is something was gross income under those rules, but Congress is allowing a special exception. These include certain life insurance amounts received, gifts, municipal bond interest, right? Interest normally would be included in gross income, certain damages in certain types of events like personal injury, those types of things. We'll talk about damages. Discharge of indebtedness. Certain discharge of indebtedness is considered excluded from gross income. Certain fringe benefits, scholarships, certain types of meals and lodging provided by an employer. So these are all examples. We'll talk about other ones as well. Some of the ones I mentioned are the major ones. But the idea here is we're looking amongst the safari of different types of exclusion provisions. There's quite a lot that get focused on in the law. Okay? And whether you're taking the CPA exam, the bar exam, whether you're looking at it from an accounting or a law lens, this topic has a lot of stuff going on. So keep in mind, again, we're looking at that surrounding safari for different types of animals, different types of exclusions. We've already determined, hey, we've got animals out here, right? We've got gross income, but now these items we're considering, are they not gross income because maybe exclusion would take it out and not put it on the tax return, would exclude it from being on the tax return. So that's what an exclusion is, and let's go ahead, let's go to work, and let's look at this more.